Welcome back to another episode of the Cheap Property Spain podcast. Today's episode is all about mortgages. I've gotten loads of questions over the years about how to get a mortgage in Spain. So I decided to ask an expert. I sat down with Rob Govier of MHI Group, an international mortgage brokerage with offices all over the world. Rob is an international mortgage veteran with over 30 years of experience. He's based in London but knows the Spanish mortgage process in and out. We cover everything today that you need to know about how to get a mortgage for a home in Spain. From the documents you need, how to apply, the amount of loan you might qualify for, how home valuations work, and so much more. Enjoy. Rob, thanks again for coming today, and just love to start off, if you could just tell us a little bit about yourself.
Sure. Okay. Well, my name's Rob Govier. I'm one of the directors of the MHI Group. We are a international mortgage brokerage. We're based in the UK and Spain. Personally, I've been in the finance market for over 30 years, 16 of those within the Spanish mortgage market. So obviously bringing with me a huge array of experience of both Spanish markets and other international markets as well. But Spain is one of our core markets. Obviously, it's always a hugely popular place to be buying property in.
Yeah, of course. So you guys do lending and brokerage for not just Spain, though, for all over the world. Is that right?
That's correct, yeah. Our core markets, as I say, do tend to be Spain, France, Italy, Portugal, the UK. But we do have inquiries, and wherever possible, we would assist in other countries. But they tend to be our core markets, let's put it that way.
Mm-hmm. Of course. So do you make it over to Spain much?
Not often enough, unfortunately, but I do get one of my co-directors, who is based in Spain, sends me lovely images on social media of him normally enjoying quite a nice beer with a Mediterranean backdrop. You know the sort.
Oh my gosh. I don't think you should be friends with him anymore. He sounds
well,
terrible.
Really, I shouldn't, but I've known him for the best part of 30 years, so I probably should, yeah.
Hard one to shake.
Yeah. It is indeed.
Well, great. Well, let's zoom in a little bit on Spain specifically, and
Sure.
I'd love to just get an idea of, a general overview. How does the mortgage process work in Spain for an expat mainly? Someone who maybe doesn't live full time in Spain yet, or all their income is derived from another country of some
Sure.
kind.
Okay. So we'll keep it simple and classify them as a non-resident buyer. Depends on where the client comes from. So as a rough guide, if they're from a country within the EU, the lenders will lend typically up to 70% of the purchase price or valuation, whichever is the lower. If they're from a non-EU country, so obviously USA, UK would be two countries that instantly spring to mind, then they generally lend 60% of the purchase price or valuation. Now, that's a general guide. There are exceptions to that, as there always are. So because we deal with every bank in Spain, then of course we have to generalise to a large extent. But that's a rough guide that in terms of the percentage that you can borrow. In terms of how they assess you in the process, it's fairly straightforward. They will ask for various documents. So let's take, and there are different scenarios. So they will obviously need, first of all, proof of income. So that could be for employees' pay slips. If you're self-employed or a director of a company, for example, they normally require tax returns from the country where you generate your income. They'll also need to see proof that money hit in your bank account. So they normally need to see personal bank statements. And if you have a business, they'll also need to see business bank statements. They need proof of who you are. So that would typically be a copy of a passport. They'll also need to see your credit report wherever available. Not available in every country, but most countries you have to provide a credit report. And that's obviously from a lender's perspective to assess what information you have or what credit commitments you currently have, which will be in addition to any mortgage that you'll be taking out in Spain. The final item that they need is proof of savings that you currently have. So they're the fairly standard basic requirements. Certain lenders will always ask for additional information, but that tends to be the core information that lenders will require. What the lenders then do is they lend based on what we call affordability. Okay, so very simply how that works is they look at what income you have coming in, they'll look at what credit commitments you currently have going out. So that could typically be for example, a mortgage, loan, credit cards, car finance, hire purchase, etc. And basically what they do is they look at what you have coming in, what's going out in, if you like, in your main residence typically, and then they then combine that with your proposed mortgage that you wish to take out in Spain, and providing you fit within their calculation, you will then be approved for the mortgage. Now, what I would say at that point is that each lender has their own calculation. Some are more generous than others, and also sometimes depend on the country where you come from. So, for example, if you come from one of the countries in the EU bloc, they don't have to allow for currency fluctuations because, of course, normally the client would be paid in euros. The mortgage in Spain would, of course, be in euros. So there's not that fluctuation. Clearly, if you're coming from, I don't know, the UK, for example, they have to factor in that, of course, sterling can fluctuate. Therefore, that's something that they will build in a bit of margin for. So it's not a straightforward, yes, every lender does it this way. They all have, that's the formula. But as I say, in terms of the percentages, that will vary from one lender to another. And that's really how the process works. Once that's all been approved, it's always going to be subject to a satisfactory valuation of the property. So they will employ an independent valuation company to visit the property. And providing that all comes back okay, then of course the mortgage would then be issued on the terms that you require. Then exception to that, for example, would be if the property is valued at a lower figure than the price that you've agreed, because as I mentioned to you a moment ago, they will lend up to 70% of the purchase price or valuation, whichever is the lower figure. But as I say, assuming everything comes back on the valuation okay, then the mortgage offer is issued, and that's the process really.
Okay. Wow. Yeah. Great. So of course it depends on so many factors, like you mentioned, whether your income is derived from an EU country versus, somewhere like the UK or the US where, you're paid in pounds or dollars or you're not part of the member block. So a lot of personal factors to consider, right?
Correct.
And then how does the process change when, depending on like property type, right? So you mentioned like the loan up to 70%.
Sure.
Is that across the board, or how does that change if I'm looking at an apartment versus a single family home versus like one of these beautiful rustic Galician estates?
Yeah, okay. Fairly straightforward answer to that. Properties are classified in Spain. So what they put in English, it would be what we call urban property, or urbanista is the actual Spanish phrase. So that would be your fairly normal apartment or villa, etc., etc. And they will be, as I say, up to those percentages that I've disclosed. If, however, the property is what we call rustica, so that would typically be what we would know as a farmhouse or a finca, as it's known in Spain. Quite often, the lenders will do one of two things. They may not lend on them full stop, or they may reduce the lending to a lower level. So they may, for example, only lend 50% on those types of property. So that there's a big difference. So it's very important, if you're looking at buying a property, you establish with the agent that you're perhaps hoping to buy the property through, what the property is classified as. So they tend to be the fairly standard ones. There are some other exceptions to that, but I won't go into too much detail. They tend to be the main ones. Most people will either buy a fairly straightforward villa, apartment, townhouse, which is on urban land, but it's those clients who perhaps are looking for something in a bit more inland, typically, which there may be issues. But again, very straightforward for us to find that information out. Once we have that, then we can know which lenders will consider it and which lenders won't consider it, and obviously the percentages that they may consider on that type of property.
Okay, that makes sense. So do you recommend buyers find a property first or come to you first to get like a pre-approval?
The simple answer would obviously be to come to me first, but there's actually a genuine reason. You get a lot of people who may arrive on a plane, typically, and look at properties and think, I'm sure I'll be fine for the mortgage. Don't see any problems. I have good income. These are fairly standard comments that you might get from somebody, but they don't understand the process or the way that lenders assess you. So quite often, you will get a situation where somebody may have reserved the property, put down a holding deposit, which is fairly standard, only to then go along to a bank and find out, actually, no, they've not been approved for the mortgage. So quite often, we might get involved at that point. And again, sometimes we can help, sometimes we can't. But that's the reason why we say, look, whatever you do, just make sure you can get the money first, because it doesn't cost you anything to do that. So we always recommend what we call an agreement in principle. So we will basically do our own initial underwriting, if you like, and make sure that we feel it's going to fit. We'll then approach a bank to who we feel is most likely, who at that moment in time may have the best rates for that particular client as well, to get an agreement in principle. So prior to going out and visiting properties, get the mortgage agreed. So if you then do come over to Spain, find a property that you wish to buy, you have the sort of safety, if you like, that yes, I know I'm good for the money. Obviously, again, subject to satisfactory valuation, okay, but you're approved, if you like. So it's only then down to the property being signed off, if you like, by the bank. So always, always, always get it agreed prior to any visit. Seen too many people let down over the years, and quite often those deposits can be non-refundable. So they may have paid a sizable amount of money in terms of taking the property off the market. It's lost, and it would have taken them not a great deal of time for them to forward the required information to us. We could have got it agreed, and so, you know, or we could have told them straight away, said, look, love to tell you, but it's not going to work, okay? So being blunt, you know, don't go and buy it, or you can't buy at that level. And typical example of that might be a lot of people don't always appreciate the full extent of the costs involved in buying a property in Spain. So it's not just obviously the deposit required for the mortgage, but of course there are a number of other costs. So property purchase tax if it's a resale property, or IVA if it's a new build, obviously legal fees, notary fees, mortgage arrangement fees, mortgage valuation fees, the list goes on. And so sometimes they might say, I've got this amount of money, okay, but I want to buy at this level. Well, they haven't got enough money to cover all of the costs. So we might say to them, you may want to buy this, but unless you can find some more money to put down as a deposit and obviously to cover all the costs, you really need to trim your budget back down. So again, that's another benefit of speaking to somebody like ourselves, first of all, so that you have that, again, you know that what you're looking at property wise is going to be affordable, going to be something that you can cover the cost for, and obviously that you can get the mortgage agreed for that level.
Of course, that's great. That makes a lot of sense. And I love that you started touching on costs, because that was my next question for you. So what are some of the sorry, what was that, Rob?
I thought I'd get one ahead of you.
yeah, no, you're well prepared. So what are some of the costs that a buyer can expect, particularly when they are taking out a mortgage?
Yeah.
And then what kind of overall percentage should they plan to reserve within their cash, the cash part of their budget?
Okay, so I've touched upon the typical costs. So obviously property purchase tax if it's a resale property, or IVA if it's a new build, also stamp duty on top of that if it's a new build. But just touch upon the property purchase tax. This again isn't always known by buyers, but the regions in Spain are autonomous. So basically they set their own property purchase tax. So again, if I use two particular regions where we get a lot of clients who are looking to buy in those areas because they tend to be very popular with overseas buyers. One is called the Alicante region. The other one is the Murcia region, just south. Now, if you purchase a resale property in the Alicante region, your property purchase tax is 10% of the purchase price. If you drive south to Murcia, it's 8%. And again, each region in Spain does have their own property purchase tax. So always, always, always find out what that cost is, because, you know, again, it might be you've worked, and again, agents will say, oh yeah, budget around 10%. I can tell you factually, if you're taking a mortgage, it will always be more. For example, if you're buying the Alicante region, straight away it's 10%. Obviously, legal fees that you will be charged. There's notary fees where obviously you sign for the property. Relevant to the mortgage, you tend to have two costs. Okay, the first one will be a valuation fee. So obviously, as I mentioned earlier, they will require an independent valuation company to visit the property. They will charge a fee, which tends to be based on the value of the property. So obviously, the more expensive the property, the more they would charge you. Typical cost would be €400-500 is fairly average. But as I say, if it's a more expensive property, you can budget more than that, or need to. The other one is the lender would typically, not always, again, because I have to be generalised here, will charge an arrangement fee, typically between 1 to 2% of the amount that you borrow. So keep it simple. If you borrow 100,000, you can look to budget between 1 to 2,000, which is the lender's arrangement fee. Okay, they tend to be the cost that you will physically have to pay. There are additional costs that the lender has to pay, but that doesn't concern you because you won't physically have to pay those. So you need to budget. Typically, if I take a normal region, we, as a rough guide, we work on around 12% of the purchase price to cover on a resale property, the purchase tax, legal fees, notary fees, mortgage valuation fees, and lender's arrangement fee. So rough guide, it's not exact science. And obviously, we'd always advise you to get an exact breakdown from any solicitor that you appoint, who will go through all of the costs on the legal side. We will obviously go through all the costs on the mortgage side because that's our remit, if you like. So again, region to region, that will vary. And again, if you're buying a new build, it will be more expensive again. So just find that information out before you go and sign for any reservation agreement, if you like.
Yep, great. That makes a lot of sense. And yeah, that's a good watch out for anyone who's planning to buy with a mortgage specifically. Budget, it sounds like a minimum 10% over your purchase price just to have extra to cover all the taxes and fees and whatnot.
Yeah.
Great. Well, you briefly mentioned it, but I'd like to ask you a little bit about new build.
Sure.
So, there might be a small group of people that are maybe interested in purchasing land and building on it. Are loans available to do that in Spain?
They are. Yeah, very simply, they're called what we call a construction mortgage. So in essence, what you have to do is, if you're buying a piece of land becomes available, you pay for the land in cash. You can't get finance on land. So you can then, obviously, if you're going to do what I would call a self-build, so you're going to build a villa to your specifications, ultimately. A lot of people like it. And very simply, what will happen is a lender will essentially lend you a certain percentage of the construction costs of that build. They will tend to release it on what I call a stage payment basis. Okay. Now the advantage of that is, let's say, for argument's sake, it was going to cost you 200,000 euros to build that property, and you said, I would like to borrow, say, 140 against that. Well, clearly you don't want 140,000 released straight away because, of course, you'd be paying interest on it from day one. So they release it on what we call a stage payment basis. So as the construction gets to certain levels, obviously the architect who's normally supervising the project will, if you like, sign it off, and then the bank can then release that tranche of funds, so you then get on to the next phase. So it's doable. Not many products in the market, not many lenders offer this type of product, but there are lenders in the market that do, and that's a general guide. So, but you have to purchase the land outright first. Then, as I say, the construction mortgage is the route to go down, and it just works. As I say, not everybody does it, so I don't think you can do that if you buy on a development, for example, because of course you won't own the land. So if you buy on a development where the builder's building X amount of villas, okay, you can't do it on that because, of course, the developer is, of course, building that property. So it's only one that you're going to do what I would call a self-build, purchase the land in cash, and then, as I say, a construction mortgage to finance part of the works. Okay,
great. That makes a lot of sense. That's for those who are willing to take on a project like that.
Sure.
To me, that sounds like a huge undertaking.
Well, yeah, it is, particularly where construction costs, obviously, of materials obviously going up through the roof at this moment in time. So it's, again, a difficult one to budget. What was a construction cost a year ago, generally speaking, is going to be a bit more today.
Yeah, of course. So let's dive in a little bit to sort of mortgage specific. So where I'm from, and I think a lot of Americans will relate to this, you know, the 30-year fixed rate is kind of the standard product.
Cool.
Some people go for a 15 to get, pay off a little bit sooner.
Yeah.
What is sort of the term and the product all around that you can expect to find in Spain?
Okay. Again, I generalize it because there are exceptions, but most lenders will offer you what's called a variable rate mortgage. Okay, so that will be linked to what is normally, again, but some lenders do it slightly differently, but it's normally linked to what we call the 12-month Euribor rate. So the 12-month Euribor rate is not, first of all, a Spanish rate. So if you were taking a mortgage in France, Italy, Portugal, for example, lenders will link it to the Euribor rate. So basically how it works is fairly straightforward. The Euribor rate is obviously set on the date that you complete, and then a lender will typically charge you a certain percentage over and above that. So if a lender says, okay, whatever the 12-month Euribor rate is, we would charge you, say, 2% over and above that. Okay, so let's say the rate at this moment in time is a shade over 2.5% as we talk here. So 2.5%, you add your 2% to that, your pay rate would then be 4.5. You then have a mortgage anniversary. So let's say you completed on the purchase of your property today. 12 months time, of course, will be your mortgage anniversary. And let's say in 12 months time, Euribor rate was 2.6. Put your 2% on top of that. For the next 12 months, you'll pay 4.6. So the guarantee you've got is you're always going to be above the 12-month Euribor rate on that example by 2%. Of course, what we don't know is each year what the 12-month Euribor rate is going to be. So that's the product which the vast majority of banks will offer to non-EU clients. And I must stress that. There are a couple of lenders that will offer fixed rate mortgages for clients who are non-EU. And they do tend to be for the life of the mortgage. Not always, but most of them tend to be for the life. So if, as you using your example, you took a 15-year mortgage term, you would get a 15-year fixed rate. So you know exactly where you are, you can budget. As we speak today, of course, there is a lot of volatility in the money markets. So a lot of lenders have sort of pulled these products, if you like, or withdrawn them temporarily, or because they're very difficult for them to price at this moment in time. But in the normal market, it's fair to say that certain lenders will offer you a fixed rate, and that fixed rate will be fixed for the term. But as I say, that normally only applies to EU clients, but there are certain lenders that will offer those to non-EU clients as well. So again, from your perspective, if that's something your client wants and insistent on, if you like, again, we would know which lenders we could go to that offer that type of product.
Mm-hmm. Okay, that makes a lot of sense. So again, really depends on where you're coming from an income perspective.
Yeah.
But then, and then with the variable rates, what's the terms? Are they typically 15 or 20, or do you have, is 30-year offered?
It depends on a number of factors. First one is the age of the applicant. Okay, so for example, certain lenders may require the mortgage to be paid off by the time the eldest applicant hits a certain age. So if, for example, I've got a 55-year-old client who is looking to take a property and it's with a certain lender, they may require the mortgage to be paid off at age 70, for example. You'll get a 15-year term. Conversely, it might be another lender we can goes to age 75, therefore he could get a 20-year term. So it just depends on the lender and depends on the age. Conversely, if I've got a 40-year-old client and they want to keep the repayments down to minimum, certain lenders may, for example, do a 30-year term. So you know, it just depends on the age of the client and the requirements of the bank. Certain banks will do a maximum term irrespective of the client's age. So some banks, for example, say maximum term we do is 20 years. So you know, if it's 40 or if you're 50, you know, it doesn't actually matter. Their maximum term is 20. So again, depends on the profile of the client and depends on the bank and their obviously their bank's policy with regards to paying off the mortgage in a certain time frame.
That's interesting. Do any lenders in Spain require the borrower to take out life insurance?
Okay, here's a really good one. You'll like this one. Okay, they passed a law a few years ago now, which basically states that the lender cannot insist that you take their insurance. Okay, so for example, there's various insurance products. So life insurance is obviously one of the common ones. Home insurance would be another one that people might want to consider, etc., etc. Now, what you will find is that certain lenders will give you a rate of interest, but that will be subject to you taking additional products with them. So they can't make it compulsory. So they basically say, okay, well, that's fine. If you don't want the product, that's absolutely fine. However, the interest rate we're going to charge you will be considerably higher. Okay, so if I use one example that I can think of this precise moment in time, got one particular bank will give you a discount of 1%. The life that you keep the policy for taking out a life insurance policy with them, and an additional 0.35% for taking home insurance. So it's a 1.35% discount, which can be quite sizable. If you choose not to take that, they're still going to give you the money, but you'll lose those discounts. And that's basically how the lenders, being lenders, are creative, shall we say, with the way that they interpret the rules. So that's a general guide, and they're the most common ones that lenders will use. So, say not compulsory. However, just be mindful that the rate may not be as keen if you don't take their product. And again, we'll very simply look at the cost of that and say, look, there'd be certain cases actually is beneficial to the client. So that would typically be for a younger applicant, because of course the cost for particularly life insurance will be less expensive. Conversely, if you've got somebody who's a bit later in years, the cost of that can be quite prohibitive, and therefore any saving they're making, if you like, by having that reduction on the interest rate is more than swallowed up by the insurance premiums. So again, we'll do a full analysis and say that in our opinion, it's better for you not to take it. Appreciate the monthly repayments will be a bit higher. However, we can't justify you take that product because it's frankly too expensive.
Okay. Wow. Yeah, that is interesting. Because I've heard about that in the States. That's not even really part of the conversation of obtaining a mortgage usually, but I've heard that from a different groups of people who purchased homes in Europe and they had to take out the life insurance, or they were highly incentivized to take out the life insurance.
Highly incentivized. I mean, yeah, in the old days they were very blunt prior to the law that came in. It was, if you want this mortgage, you're going to have to take those products. And because it's not been unkind, you didn't know anything better. You took them, and people were not particularly well looked after, shall we say politely.
Of course. All right. So let's kind of walk through, kind of summarize this buyer that we've kind of been talking about a little bit. Sure. So let's assume they do everything right. They call you first.
Yep.
They get kind of like this pre-approval, and they understand how much money they have to afford. They find their dream home, and they make an offer, and it's accepted. How long does the mortgage process then take to actually obtain the funds and close on the house?
Yeah, again, depends on the lender, because obviously each lender has different processing times, and also depends on the time of year. To quantify that, for example, if you're looking at trying to get some finance in August, if anybody knows anything about Spain in August, not a great deal happens, okay? So we have inherent problems, or banks have inherent problems of, yes, they tend to have a very much of a skeleton staff in the month of August. So, but in a normal time, and this again comes back to that point, if you've got the agreement in principle, the lender is already happy with you. They've already approved you. So the only thing they may require, depending on how long it's been since they've given you that approval, may be updated documents. So for example, if we're here today and you might have got the approval 3 months before, let's say, okay, we need 3 months bank statements, we need an updated credit report, and if you're employed, we'll need 3 more pay slips, just to see that your situation hasn't changed. So obviously your income hasn't dropped and you haven't taken on any additional credit commitments. So let's take all that, and it's all been fine, and that's it. Next step is the valuation of the property. Value visits the property, says, yeah, everything's fine. Typically 3 to 4 days later, you will get that valuation report back at the bank. That will then need to be signed off and obviously assessed to make sure they're happy to lend on that property. Assuming that's all okay, then the full mortgage offer can be issued. Rough guide at this moment in time, I would typically say about 3 to 4 weeks from start to finish would be realistic. I can assure you there's a lot of clients that fall outside of that time frame, often because it might be the bank has issues because frankly they've got too much business coming in and they can't cope with the volume, or it may be that they've requested updated documents and the clients are quite slow at getting updated information to us. So assuming that, if we request updated documents today and the client gets them back to us tomorrow, there's no delays. So, but typically 3 to 4 weeks. At that stage, the mortgage offer is then issued, goes to the solicitor acting on behalf of the buyer, and they will then have to forward that to the notary, okay, where you're going to sign for the property. And there has to be at least a 10 days before you can actually sign for the property. So that's what I would call a cooling off period, okay? So that again was part of the law that was changed a few years ago. So if, for example, mortgage offer was issued today, then and the notary received that today, then you've got to allow, again, at least 10 days before you can physically sign and complete on the property. The documentation, of course, will all be in Spanish, because for it to be a legal document, it has to be in Spanish. So again, what we normally advise, particularly if your clients are not particularly conversant in Spanish, or that you work with a solicitor that can speak in their language, whether that's, German, Scandinavian, British, American, whatever it might be. That's really very key, so that they will obviously have to explain that information, because and quite often solicitors are often given what we call power of attorney. So to save your client keep flying over to Spain to sign documents, for example, they will be given power of attorney by the client. So they would actually sign in for that mortgage on the client's behalf. Clearly, it's very important the client knows what the solicitor is signed on their behalf. So they will go through everything with the client to make sure they're happy, and it says they understood it. Clearly, we will put that in English, and we'll summarise the salient points, if you like. But again, we don't physically sign for the mortgage on the client's behalf. That's down to their solicitor. Again, you don't have to do that, but most clients tend to go down that road.
Yep. Yeah, that makes a lot of sense. And just for anyone listening, we also have another episode where we interview a real estate lawyer, kind of talking about that specific
Brilliant. Okay.
topic.
We can go into more detail about that. That's fine.
Yeah, plenty of detail out there. But you're right. It's really important to have everything translated into your language and have someone you can trust on your team to sign those documents for you, because it is a big decision.
Yeah, definitely.
So great, Rob. Well, I think we covered a ton of ground. This was an incredible overview of this entire process, which I think for a lot of people is sort of like hidden behind a veil. And I think you've done a great job, moving that and providing a lot of clarity. So
good.
Thank you. Before we go, are there any last, tips or something maybe from your experience and all the years of working with different buyers? Is there anything you'd want to leave with like a first-time home buyer in Spain? Yeah,
I think, again, the key thing I would always say to people is know the area, because Spain's a vast country, and you touch upon, there's an area of Spain you particularly like. And people often ask me, where would you buy? And there's a very straightforward answer to that. Where I want to buy might be completely and utterly different from where you want to buy. Some people like something a little bit more Spanish. I know it sounds strange because you're buying in Spain, but something which has a more traditional Spanish feel. Some people prefer to be in an area where there's quite a large expat community. So I think the key thing is, look at the areas first of all, because those areas across Spain vary dramatically. So from one area to another, one region to another, the areas, you've got to find an area that feels good to you. And it might be that you find these wonderful properties, but actually you don't like the area. So it might well be that you go down the coast and think, if I could have picked this up and put it down there, yes, I would buy it. Obviously, establish your sort of budget is really key, because again, there's quite a lot of variation in property prices. So if you go down to, for argument's sake, Andalusia, down towards Malaga, Marbella, around that sort of area, that tends to be very, very expensive. So you might need to come up coast to places like the Costa Blanca, which is Alicante region, where prices tend to be a bit more affordable. And again, even in that region, if you go to Costa Blanca North, that would be more expensive than Costa Blanca South. So again, fill an area that's right for you. They will probably be the most important things. But just do your due diligence. Do your research. Establish. If you're going to buy on, for example, a resort, typically a golf resort, which are quite common in Spain, establish what those fees are, because there will be community fees, because you've obviously got to maintain the golf course, the communal grounds, swimming pools, etc., etc. So again, that can be quite expensive. And if you're working on your budgets, you might say, oh, great, this is going to cost me X per month on the mortgage, but then there could also be a community charge, or more often not will be. So establish what those additional costs might be, so that when you're crunching your numbers, the numbers actually work for you. But I'd say that's really the best advice I'd give. Just get to know the area. And then once you've chosen the area, within that area, try and find the areas that you really like. So once you've done that, that's really the time, so do a lot of work. You can use the internet, but the internet, is great, but it doesn't obviously give you a true reflection. Best thing you can do is actually get on the ground, get out there and get a feel for the area yourself. once you've done that, as I say, and you feel the area is right for you, that you wish to buy in, then just go for it. But just get the pieces of the jigsaw in place first. By all means, speak to a solicitor about obtaining legal documents, NIEs, which obviously somebody you feel comfortable with, who will speak in your language. Obviously, get a mortgage agreed if you're taking finance, again, because as we've already touched upon, you don't want to get in a situation where you found a property and obviously you then find out you can't get the money. So, fairly basic stuff. Nothing. Not going to break any sort of fantastic. Oh wow, Rob, I never thought that before. But it's just common sense, really. A lot of it. Don't leave your brains on the plane, as somebody once said to me.
I couldn't agree more, though, with this advice, Rob. It's true. A lot of it does come down to common sense, but when you're doing something like moving, across an ocean or even just, over the English Channel or something, a much shorter distance or down, it can get exciting and emotional, and you can start making decisions that you never would have made back in your home country.
Exactly that.
So
exactly. Seen it too many times.
Yeah, right. Exactly. Thank you for listening to this episode. Really hope you enjoyed it. If you want to learn more about getting a mortgage in Spain, you can visit the MHIGroup.com. Please like this video or rate us on Apple Podcasts. Really helps the show. Ciao!